day, everyone, and thank you for joining us. I'm Sanisha Packirisamy, Group Economist at Momentum Group. Welcome to our quarterly economic lens, where we delve into macro developments in the global and local landscape. At the start of 2026, the global economy appeared to be moving into a more supportive phase. Inflation was easing, interest rate relief was becoming more likely, and economic growth had remained surprisingly resilient. That outlook has become more complicated. Geopolitical conflict has disrupted energy and shipping routes. The artificial intelligence investment boom is creating unprecedented demand for capital, and elections are reinforcing protectionism and policy uncertainty. These developments, nevertheless, share a common thread. They are increasing the cost of energy, finance, and economic security at a time when governments and businesses are already operating with less room for error. For South Africa, the picture is equally mixed. The economy has shown resilience, and reform progress is visible, particularly in energy and logistics. But the recovery is being slowed by renewed pressure on household budgets, weak investment, municipal fragility, and a more difficult inflation environment. In this discussion, we will unpack the major forces shaping the global outlook before turning to the themes that will determine South Africa's economic path. To help us make sense of these shifts is Tshiamo Masike, economist at Momentum Group. Tshiamo, thank you for joining us today. A lot has happened in the last quarter, but let us begin with the global risk backdrop. While much of the early attention was on the oil price impact of the conflict involving Iran, the economic effects have spread much further. Disruptions to shipping, rising insurance and freight costs, and pressure on fertilizer and industrial inputs are all adding to the costs across global supply chains. And at the same time, geopolitical tensions elsewhere, such as in Russia and Ukraine, have not disappeared. So how should we think about the combined effect of these pressures on global growth and inflation, and what they could mean for the path of interest rates from here?
Thank you for having me, Sanisha. So the conflicts are really weighing on economic growth while at the same time pushing inflation higher. And the IMF forecasts really paint this picture quite well. So if we turn to this chart over here, these are growth estimates and inflation estimates from the IMF. On the left-hand side, you're seeing that with each update, the IMF has actually revised global growth down. So they were expecting global growth to be 3.3% at the start of 2026. Now they're expecting global growth to be 3%. But what you're also seeing is that emerging markets and developing economies are expected to take a bigger knock in terms of economic growth. And this is because they are more exposed to energy markets, plus they are not as well positioned as advanced economies to take advantage of the AI investment boom. When you look to the right, you have the headline inflation estimates. Those have been revised higher from 3.8% at the start of the year, all the way up to 4.7% at the latest update. The good news, though, is that the global economy was not really caught off guard. So when the war started in the Middle East, we had good supply of crude oil inventory, and that did help cushion that initial supply shock. The challenge, though, is that rebuilding those inventories will take time. So when shipping routes reopen, companies and countries will want to rebuild that stock level, and I think that extra demand will keep prices elevated. Also, when you look at refined products like diesel and jet fuel, the prices there will likely remain higher than crude because the stock levels there were lower. If energy prices remain elevated, then households will continue feeling the pressure, but also businesses will have to deal with higher input costs. And this is a combination that leads to weaker growth and much more stickier in inflation. That leaves central banks in a difficult position of balancing weak economic growth and high inflation. What we have observed so far is that most of the global central banks have actually opted to keep rate constants. So of all the global central banks, it's only so far been the European Central Bank and the Bank of Japan that have hiked interest rates. The US and Japan's intervention has pushed the yen stronger, easing the pressure on the Bank of Japan to tighten monetary policy, provided the stronger yen is sustained. But the market is still expecting central banks from the US and the UK to hike interest rates.
I think another key theme playing out in the global economy is this extraordinary scale of investment in artificial intelligence. The largest technology firms are committing vast amounts of capital to data centers, advanced semiconductors, cloud infrastructure, and the energy systems that are needed to support them. In some measures, the spending is approaching or even exceeding the investment intensity of the late 1990s internet boom. But high investment does not necessarily mean that the technology itself lacks economic value. When we look back, the internet ultimately transformed the global economy, even though many early investors overestimated how quickly the financial returns would materialize. So, are we seeing a similar pattern now with AI, where a genuine technological revolution may still be accompanied by excessive valuations and investment running ahead of near-term revenues? Or do you think we are seeing elements of yet another tech bubble?
There are definitely similarities between the current AI investment cycle and the dot-com era, but there are also differences which are quite important. But I think a key lesson from the dot-com era is to say that we can have a technological advancement at the same time having a market bubble. So the two can exist. The signs of a bubble are certainly there. So valuations are high, investment has surged, and also there's a lot of expectations about future returns, and I think that's quite optimistic. One important difference, though, is that the companies that are fueling this AI investment are actually in a better financial position than the companies that were driving the dot-com bubble. So, for example, they are more profitable, the cash flows they're generating are quite strong, but also they have stronger balance sheets. And that is why then they are able to invest into this AI infrastructure. But the challenge is that the scale of investment is now growing at a faster pace than the cash flow that they are generating internally. And you can see that on this chart over here. But also this is why then these companies are increasingly looking beyond their own cash flows to finance the expansion. So when you look at IPO activity, that's increasing. When you look at equity issuance, that's increasing, but also the private credit market is now playing a bigger role in terms of funding this expansion in AI infrastructure. So I do think AI will transform the global economy. The question is whether revenues and earnings grow quickly enough to justify today's valuation. That's what I think investors will be watching for over the next few years.
I think that brings us to the question of, competition for capital globally, and especially at a time when borrowing is no longer cheap.
Yeah.
Governments are issuing a records amount of debt. Corporates are facing large refinancing needs, and the AI build-out requires enormous levels of funding. Can markets absorb all of this borrowing in an orderly fashion?
So I do think markets can absorb this increased funding. It's just that it will come at a much higher cost. So capital is still available, but it will be more expensive. And that's because we're seeing the pressures of funding coming through from all different kinds of sources, all at the same time. Governments are creating the biggest pressure. We can see this chart over here. This is data again from the IMF. It's looking at gross debts as a percentage of GDP, and it has been trending upwards for a couple of years. But also the IMF expects this to continue going up. Global debt levels are already at record high, but also governments are still trying to borrow more so that they can fund the larger fiscal deficits, but also the spending requirements that are coming through from defense spending. This then means that governments and the private sector are competing for the same pool of capital, and therefore this is driving borrowing costs up and can potentially then crowd out private sector investment. Another challenge is that a lot of the debt was issued at a time when interest rates were close to zero. So what's happening is that now as the debt matures, then there is a refinancing need, which then needs to be refinanced at much higher borrowing costs. And this is putting pressure on things like budgets and profits. Ultimately, I think a lot will depend on whether investors trust that governments will have sustainable plans to be able to make sure that they do cap their debt levels from going significantly higher. So governments that have better fiscal positions and more sustainable plans will continue to attract capital. But governments that are losing faith by the market, the confidence is getting weaker there, they will still incur higher borrowing costs. So I don't think the risk is that capital suddenly disappears. It's that it becomes more expensive and investors will then pick and choose who they lend to.
I think a related question here comes to mind, and it's really about how that AI investment boom is being financed. Traditional banks have become far more constrained by regulation and balance sheet requirements. And so we've seen that private credit has now stepped in as an increasingly important source of funding. This has helped to unlock capital at a scale and speed that conventional lenders may probably not have been able to provide. However, much of this lending sits outside of the traditional banking system. So valuations here can be less transparent, loans are less liquid, and risks may be concentrated amongst the interconnected lenders and the investors. So if the expectations around AI revenues or asset values prove to be too optimistic, could the private credit channel become the one in which stress then spreads more widely across the financial system?
That's certainly an area that does deserve close attention. But when we look at the data, it's not suggesting that the private credit market is a point of significant financial systemic risk at the moment. Yes, the market has grown quite significantly. It has quadrupled since 2010, but the quality of those loans remains relatively well, and the bad debts are also still quite low. However, the concern is less about the loans themselves and more about how that market has now become connected to the traditional financial system. So when you look at this chart over here, it's showing how banks are now lending more and more to non-depository financial institutions than they were a decade ago. And I think this is a clear transmission channel of how stress in the private sector market, private credit market, can then transfer to the traditional banking sector. You mentioned transparency and liquidity. Transparency is indeed an issue because these loans and this credit is done on non-public platforms. So it does then become difficult for investors to assess the value of these loans, but also to see where risks are now starting to emerge. So this can become a problem if then stress does emerge in the private credit market. Liquidity is also a concern because the nature of these loans is that they are long term. So if investors want their money, it may be difficult to sell quickly and get that money quickly, again adding to stress that could potentially then come through. The good news is that we're not seeing those stresses today. So banks remain well capitalized. So I think the private credit market should be seen as a vulnerability rather than a crisis at the moment.
So we've discussed a lot about capital and AI, but I think let us now turn to politics. US voters remain concerned about prices and the economy. President Donald Trump's approval rating has weakened, and the president's party has historically always lost ground in the midterm elections. Meanwhile, the announcement of new tariffs has reinforced protectionist policies, despite the courts challenging some of the earlier tariff measures. What do you think the midterms could spell out for economic policy, global trade, and just financial markets in general?
The upcoming midterm elections will be very important because they will determine how much of President Donald Trump's policy agenda can be implemented over the next 2 years. He does enter this race in the midterms at a much back footing than he did previously. When you look at his approval ratings on this chart over here, it shows that it has fallen from just below 52% all the way down to 39%. And this is when the cost of living crisis is weighing on consumers and it's starting to show in these numbers. Another important factor going into the midterm elections is the growing share of independent voters. So independent voters did help President Trump win the election in 2024. So they could then once again be the deciding vote on who controls the House and who controls the Senate. So what could the midterms mean for economic policy, markets, and global trade? I think it all depends on the results of the elections. And there are three scenarios that I want us to go through. The first one is if Republicans retain control of the House and the Senate, we are likely to see more tariffs, continued support for domestic manufacturing, further deregulation, and expansionary fiscal policy. That could lead to larger budget deficits, higher government borrowing, upward pressure on bond yields, and a weaker US dollar over time. If Congress becomes divided, then it means it may be more difficult to have legislation passed. And in this type of environment, we could have more policy certainty and less surprises for the financial market. If Democrats take control of Congress, we could see some trade measures being softened. You can have greater support for clean energy, and closer cooperation with international partners. Even then, though, I think major policy changes would likely happen gradually because President Trump would still be in office.
Turning to South Africa, the disruption to Middle Eastern shipping routes initially raised serious concerns about fuel availability, given our dependence on imported crude oil and refined petroleum products. Yet, the country managed to avoid the widespread shortages and severe supply interruptions that many had feared. At the same time, avoiding an immediate shortage does not mean the economy was unaffected, as longer journeys, higher freight and insurance costs, and increased fuel prices still filtered through to businesses and households. What do you think this episode has revealed about the remaining vulnerabilities of our energy and logistics systems?
So one of the biggest takeaways from the Middle East conflict, it just showed how resilient South Africa was, and I think many people didn't expect this. But it also did reveal our vulnerabilities. So part of the reason why we managed to then avoid that major fuel shortage is that we did quickly diversify where we import our fuel from. So when you look at this chart over here, it's showing you just between March and April, we started importing more fuel from Europe and the United States, which then meant we did decrease our reliance on the Middle East. However, because we are still exposed to international prices, we are still getting that impact from higher crude oil prices filtering through locally to higher fuel prices and higher transportation prices. But also, we had the recent suspension of diesel exports in Russia, and that also has added pressure on diesel prices. But this also shows that we are still quite exposed to shocks that are happening in the global system. One of the biggest vulnerabilities that came through from this is South Africa's very low strategic crude oil reserves. The conflict also highlighted a missed economic opportunity because what we saw is that we had more ships now passing through the Cape of Good Hope, and they weren't really docking at our ports. They were passing, meaning that we haven't really taken advantage of our geographic location. And this is something we also witnessed in 2023.
South Africa's ability to manage the immediate fuel supply points to a degree of resilience and should be commended. But that resilience is not yet translated into a more convincing macroeconomic recovery. We know that households remain under pressure from elevated living costs, fixed investment remains subdued, while constraints in electricity, logistics, and municipal service delivery continue to weigh negatively on economic activity. Are reforms in the areas such as energy, freight logistics, and infrastructure beginning now to build a stronger foundation for the medium-term growth outlook? And what do you think still needs to change for that progress to really become more visible?
So reforms are building a stronger foundation for medium-term growth. Unfortunately, though, when we look at the business leadership of South Africa's tracker, it does show that there was a slowing in reform momentum. So when you look at the chart on the left-hand side, you're seeing that it did turn negative in the second quarter of this year. And this was the first time it turned negative since 2 years ago when the reform tracker was established. And this is because on the right-hand side, economic reforms did slow quite significantly. But that doesn't mean reforms have stopped. We have seen progress and there have been positive updates. For example, Eskom's operational performance has improved significantly. You've had load shedding, which has largely been avoided. Rail reform continues to move forward. And we've had further private sector participation in both the electricity and logistics sectors. Now, these are all positive steps. It's just that we are still experiencing delays in some areas. For example, the National Rail Bill has still not been tabled. Electricity market reforms have slowed, and municipal debt to Eskom continues to grow. So while the policy direction is positive, I think implementation is one of the key areas that we need to focus on to ensure continued progress.
I think especially at a time when South Africa's local government elections are approaching, coming up in November this year, and at a time when municipal finances and service delivery are really under severe strain. The contest also carries significant national political consequences. So what do the current polling and by-election trends suggest about the risks facing the largest political party in South Africa, the African National Congress, and then just the broader direction of national politics?
Yeah. So the latest national polling data that we have from the Social Research Foundation, which you can see on this chart over here, does show that the ANC will likely to continue lose support in the local government election. But also a key insight from this chart is showing that no one party is likely to remain a dominant party. And therefore, this means that coalition politics will likely remain a feature in our political landscape, particularly at these large metros. So the most closely contested metro will likely be Johannesburg, which contributes about 18% to South Africa's GDP. And again, the polling data there suggests that the DA may emerge as the largest party, but it may then not be the outright ruling party in the metro. For the ANC, a weaker than expected performance could put pressure in terms of internal leadership, particularly at a time when you have pala issues, which are creating a lot of concerns. And those issues together then will have an impact on how the ANC performs in the 2029 national elections. So I think the local government elections will likely reinforce South Africa's shift towards an era of coalition politics. But for investors will want to know the coalitions that are being formed. Will they come about with better service delivery, better governance in these local elections? And will this then result in better investment, which will boost economic growth in South Africa?
Let's maybe change gears to inflation developments in South Africa. You gave us your thoughts on the global front. And I mean, inflation was one of South Africa's strongest macroeconomic tailwinds at the start of the year. And now there are signs that energy, food, and weather risks could converge. So how serious do you think that threat is? And what does this mean for actions from our central bank?
So the biggest change to our inflation outlook this year has really been that Middle East conflict and the impact it had on crude oil prices, which then filtered through to South Africa's inflation rate. You can see from this chart over here that transport, which is in red, did increase quite significantly, and we also saw inflation rising all the way up to 5% in the June number. The key concern is whether the energy shock will then coincide with weather-related shocks, particularly for food inflation. Currently, food inflation remains contained, but we have the El Nino now, which is more dry weather conditions, and that is a risk to the food inflation outlook. But we see that as more risk for the end of 2026 towards 2027. But also how far the Middle East conflict evolves will also then be a key determinant for food inflation, because where fertilizer prices end up, particularly towards the end of the year when we start our planting season, will then determine how food inflation then develops. So from a monetary policy perspective, I think the Central Bank of South Africa will assess whether or not the risks coming through from the Middle East are temporary or they become persistent. So in terms of raising inflation expectations, but also wage growth expectations. And they will also then look out to see how the food inflation risks do then transpire. The SARS July scenario do highlight these risks. So there they had oil prices going all the way up to an average of $100 per barrel in 2026, and inflation expectations becoming de-anchored. And if that happens, then we can expect further interest rate hikes this year. But again, the situation does remain fluid, and we could see fuel prices coming down, and that means then we can also see inflation expectations coming lower. And according to their scenarios, in that type of environment, they could start cutting rates towards the end of this year.
For home loan owners, let's hope it's the latter. Now, I think a lot of what we spoke about today spells out a global risk-averse environment. And strangely enough, the rand has actually been more resilient than many have expected. And even the sovereign ratings story has also become somewhat more constructive. What do you think is actually supporting the local currency, and can that resilience last?
The rand has definitely been surprising to the upside this year, and it has performed better than other emerging markets against the United States dollar. There are a few things that are supporting it. So the terms of trade has been supporting it. When you look at this chart, terms of trade has been elevated, although we have had that pullback because commodity prices have come through. But secondly, there has been gradual improvement in the domestic story. So we had inflation targets coming down to 3%. The fiscal story is improving, but also you had sovereign credit rating upgrades that came through that did also then help support the rand. However, the rand is an emerging market currency, meaning that we are not insulated from global risks that do come through. So, for example, if the United States increase interest rates, that would be negative for the rand, but also if we have that global risk-off environment. So I think resilience can continue, but we are not insulated from what happens globally.
Thank you, Tshiamo, for those insights. To sum it up, I think we can see a clear thread running through today's discussion, and that is energy security, AI infrastructure, sovereign borrowing, and geopolitical resilience are increasingly competing for scarce capital. The global economy remains resilient, but conflict, persistent inflation, refinancing pressures, and protectionism are testing that resilience. AI could raise productivity, but it could also concentrate risks in capital markets. Meanwhile, South Africa has avoided fuel shortages, maintained fiscal discipline, and made progress in energy and logistics. However, household pressure, municipal weakness, and renewed oil and weather shocks could constrain growth and keep interest rates higher for longer. Thank you, Tshiamo, for shedding light on these market-moving economic developments.
Thank you, Sanisha.
Thank you for being with us today. Until next time.